In this video, I'm going to show you a dead easy way to use the RSI, or the Relative Strength Index indicator, to identify decent entry points for a mean reversion strategy. And I'm going to be using the daily chart of pound versus the dollar Forex pair to demonstrate this. Just about every charting package allows you to draw on the RSI indicator, so anyone can follow along with this at home. I'll first demonstrate the rules on the whiteboard, and then I'm going to show you two separate studies. The first study is going to be a regular optimization using a large chunk of in-sample data, and then I'm going to apply it to a smaller sample of out-of-sample data, which is going to be of more recent times. And then the second study is going to be a walk-forward analysis study. And the good news is that they both work, so that suggests to me that there is some robustness to this idea or this strategy. So let's go over to the whiteboard and I'll show you how it works. When we talk about mean reversion, we're talking about when prices move away from their average to extreme levels. And our job is to identify when those levels have become extreme and likely to turn around. And then we're going to jump on the trend back towards the average. And a great way of doing this is using the RSI indicator, like I'm just about to demonstrate. I've mentioned daily chart of pound versus the dollar Forex pair. Insert your RSI indicator. Now, the standard length for the RSI is normally 14. We're going to actually adjust this. And sometimes you're going to have horizontal lines, upper and lower lines. I've drawn these at 25 and 75. Standard, they're often drawn at 30 and 70, but for this study, they're the ones that I'm using, and they're going to stay fixed throughout the study. I'm not going to change these levels. I'm only going to change the length of the indicator from the standard 14. When the indicator gets towards the upper levels, towards 75, that means that the market is becoming overbought and prices have been quite strong, and that's suggesting that they've become so strong that they're going to return and they're going to come back down at some point. So we want to almost bet against the trend. So these are going to be our short selling points when the indicator is at its extreme highs, and the buying points are when the indicator are down at the extreme lows. Now I've written the rules down here. For a buy entry, we want to see RSI crossing above 25. Now, I've done a lot of studies using RSI and I've done videos using RSI, and typically those videos have shown entering when the RSI drops below a certain level. Let's say it drops below 25. Now, the RSI can then stay below 25 for a number of bars more. Now, in this study, this is slightly different. What we're saying is we have to see it go below 25, but then our entry signal is only once it's become back above 25. So once it's crossed above 25. So it's come down, it's gone below 25, and then the prices have turned around and they've started to rally and they've closed back above 25, suggesting that the market is already moving back towards its average. Okay, so that's our entry point. When we see the first closing bar with the RSI having been below 25 but then closed above 25. And the opposite is for short selling. So we want to see the indicator having been above 75, and then as soon as it closes back below 75, that's our entry to short sell. We're going to be using a fixed pip stop loss throughout the test of 300 pips. And the exit is going to be just as simple, and it's going to be the good old bailout exit, or first profitable close. And what that means is once we're in the trade, we look at the close of each bar, and if we're in profit, we take the profit and exit the trade. If we're not in profit, we stay in the trade, and we're either going to get out at the next bar or a few bars later in profit, or we're going to hit the stop loss. Now, I have introduced a bar delay or a day delay with that, and we're going to optimize that number. So what I'm saying, if we got a day delay of 3, then what I'm saying is we need to be in the trade for a minimum of 3 bars, or 3 days in this case, and then we start looking at the close of each bar. Are we in profit or not? Okay, so the two inputs that we're going to be optimizing throughout this strategy is going to be, one, that day delay number for the exit. The stop loss is going to stay the same, and the second input is going to be the length of the RSI. So standard is 14. We're going to be optimizing between 2 and probably 20 to see which one works the best. For both the studies, I've actually included $40 worth of costs, or 4 pips worth of costs round trip for each trade. So let's go to the computer and have a look at the results. Firstly, let's have a look at a trade on the chart. And we're going to look at this buy or this long trade here. So we've got an RSI indicator down the bottom here. And what we need to see is the RSI level cross above 25. So that means it has to come below 25, which it has done. If just show you down here, this green line is the 25 level. You can see that it's come down below, but we don't enter the trade yet. It's gone up a little bit. We still don't enter the trade because it's still below 25. And then it's not until this point here where it closes above the 25 level, so it's come out of that level, that we enter on the open of the next bar. So that's a really good demonstration on this bar here. They won't always be like this. Sometimes they'll be like this one here. This stayed below only for a couple of bars, then closed above, and then we bought on the open of the next bar. Okay, so that's a demonstration of how it works. Just show you a short trade example. Here's one here. So the RSI went above 75 level, and then it crossed back below it here. So then on the open of the next bar, which was here, we went short. And these would have also been short sell signals here and here, but we were already in a short trade, so we just stayed in that original trade. So let's have a look at the first optimization. Now, this data I'm going to use from 2008 through to the end of 2018. I've done an optimization on the length of the RSI, and I've left a 300 pip stop loss, and I mentioned that day delay on the exit, and I've used just a 3-day delay. I just picked it out of nowhere. I didn't want to use any delay, but I did want to use a short delay. So for the moment, we're just using a 3-day delay, and we've optimized for the best RSI length. And looking at the net profit numbers here, we can see immediately that the best is an RSI length of 6, and RSI 5 works, 7 works, 8 works, 9 works not very well. The rest of them don't work particularly well. So the best and a fairly central level is either 6 or 7, and we're going to use 6 for this study. So the next thing I want to optimize is that day delay for the exit. So using an RSI level of 6, I've optimized for the day delay between 0, no delay, through to 10 days delay. I didn't want to go any more than that because the idea of the bailout or the first profitable close exit is a quick exit as soon as we're in profit. Looking at the net profit, we can see that the best numbers are probably around about the 1, 2, 3, they're all in the $50-odd thousand net profit, and I think I'm going to use 2 just because it's slightly more central. There's not a lot in it between 1 and 2, but I'm going to use 2 on this study. And let's have a look at the equity curve. And there's the equity curve from 2008 through to the end of 2018. And it looks okay. There's a few not so smooth parts, but overall it's definitely moving in the right direction. So I'm quite happy with that. I did want to keep the stop loss at a fixed 300 pips. I didn't want to mess about optimizing that. But out of curiosity, I did just do an optimization just to make sure we were in the right ballpark, as it were. So I have optimized between 0 and 500 pips. And I noticed that the best for net profit was actually 325, 350. It was a nice stable area, but 300 is definitely stable anyway, and we have got a large average trade. It's not as large as using a bigger stop, so I could use a 350. Let's just have a look. So using a 350 pip stop loss, the equity curve doesn't change too much. Slightly smoother through here, perhaps slightly weaker in recent years. but I'm going to keep the 300 pip stop loss. Now in this workspace I've got additional data. So now I've got data from 2008 through to the end of 2021. Well, I've actually only got data through to the present day, which is about 22nd of October 2021. So I've got 2019, 2020 and the most of 2021 as our unseen or our out of sample data. So let's have a look at the equity curve. And there we can see that we are still making decent new highs. If you remember, our equity curve in the last study stopped at the end of 2018 around about this point here where my cursor is. So everything to the right hand side is out of sample data. So we are making new highs, which is nice to see, although we have seen a bit of a drop in recent times. Hopefully that will not continue to drop and it will turn around and start to make new highs again. Next we're going to have a look at the results from the walk forward analysis study. But before we do that, if you're enjoying this video, then please hit the thumbs up button now. And if you like this type of mechanical or algo or rule-based strategy and you haven't already, then you might be interested in my new 22-page PDF Beat the Markets Trading Guide that I've put together. And at the moment, if you use the link in the description below this video, you can get that for absolutely free. And it includes 3 more trading strategies, a little bit like this. They're actually the viewer's favourite strategies that I've actually put out. So grab that now while it's available. Now, let's have a look at that walk forward analysis study. The data range we're looking at in the walk forward analysis is from 2012 through to October 2021. We can't use the first 4 years from 2008 through to the end of 2011 just because of the way that I've done the walk forward analysis. I'm using 4 years worth of in-sample data and then 1 year of out-of-sample data to build up this walk forward analysis equity curve. So all the results that you see in the walk forward analysis are all out of sample. And that's what the equity curve looks like. Sure, it's got some bigger drawdowns, it's not as smooth, but it is certainly moving in the right direction. And walk forward analysis does tend to be a little bit more accurate, a little bit closer to what real-time trading could be. If we compare the average trade value of the walk forward analysis, we've got $236 compared to the last study of $355. So quite a bit smaller, but still a decent number. And don't forget, I have included some trading costs in this as well. I know I've skipped over the walk forward analysis part of the study very quickly in this video. For those of you who are interested, I am using an unanchored approach using 4 years of in-sample data, then 1 year out of sample. If you'd like to learn more about the walk forward analysis, let me know in the comments below. Maybe I'll dedicate a video just to that. So there you have a practical way of using RSI for mean reversion on pound-dollar forex pair using the daily chart. And I'm sure to get comments saying that this sort of strategy isn't tradable because I didn't show you, but on average it trades between 10 and 15 times a year only. And if that's the only strategy you're going to trade, then maybe that is a little bit low. But I never suggest that. What I suggest is that you take 3, 4, 5, 6 strategies similar to this one that trade 10, 15 times a year, and suddenly you're trading 2 or 3 times a week. And if you've chosen the strategies and the markets correctly, you're going to diversify your portfolio and diversify or smoothen out your trading returns. Anyway, I hope you've enjoyed this video, and until the next one, this is Jared Goodwin, and thank you.